All right, we're about 4 minutes away from starting. Quantic, Snoop 8, my dog, checking in the YouTube comments. How's it going, guys? Appreciate you tuning in. And shout out to Kevin for the follow over on the Twitch side of things. We always love getting that notification noise and seeing that notification pop up in the top right of the screen when we're on. Appreciate you guys joining tonight. All right, coming up on a minute and a half on the timer. Hopefully we can get a few more people in here. If you guys aren't here, feel free to check in the chat so we know that you're out there. All right, and that is the timer right there. Let me X out of this really quickly. I wish I had some big animation that I could have flash across the screen right now to let you guys know that the stream is starting up. And thanking you for tuning in for another week of our weekly trade ideas and more live stream that we like to do every Sunday night on here. What we like to do for those of you who are new, we typically recap the week that we just had. We'll scroll down here, and a little bit later we'll talk about what we've got for the week upcoming. And then we'll go through some stocks. If you guys have any that you want us to take a look at, feel free to throw them in the chat. I'll put them on the list and we can go through those at the end. Talk about the best way to play that stock, what we see in that stock, and what we think the best thing to do going forward is. And it looks like if we're having any issues with the stream, feel free to let me know because as some of you know, the laptop that I normally use completely died on me a few weeks ago and I have not received it back from the manufacturer yet. Which is kind of a pain, but we're working on our backup, and that one is not really as strong computing power wise, but we're going to keep pushing forward right here. So here's what we had for last week. A lot of you know that we have this UWMC position where we've got a decent number of shares. We've been riding this one for a little bit of time. We're not terribly worried about that. It's labeled as the GHIV trade breakout. That's how long we've had it. That was the name of the SPAC before they had their merger. But high level overview, we started this one off at 1084. It's down to 785, but our break-even price is now 645, which is just a testament to, how effective this strategy can be at lowering our break-even price. So patience really above all else when we implement the strategy, because our break-even price can go down forever, but the stock price theoretically can't go down forever. And that's what we saw a little bit last week when UWMC popped up from 749 to 785. Hopefully we could see another increase in the stock this upcoming week. I feel like just about every single week we've had with UWMC over the past couple of months has been red, so it's nice to see that one finally turn around for us. And all in all, between the shares, the puts we sold, and the calls we sold, we came out with about $1,500 of profit from that position. One thing that's great to illustrate about these options that we sell is when the stock goes up, obviously the price of the puts that we sell is going to go down, but we like to sell these in high implied volatility environments so that these options that we sell have a lot of premium. And despite the fact that the price of the shares went up, the price of the calls that we sold went down. So that's something where, as time passes, you lose that extrinsic value on what you sell. That's why we were also able to make some money on those. We've got J March checking in the Twitch chat. What's going on, J March? Always appreciate having you in the figurative building for what we're going through tonight. And again, any of you guys who are watching have any stocks that you want us to take a look at, feel free to throw those in the chat, and we'll circle around to those at the end. But continuing to move down the list here, we've got Psth. This is one that we've been holding on for a while as well, just chipping away with these weekly calls that we're trying to sell. We sold 26 strike calls that expired last Friday. We did the same exact thing for next week, just trying to knock about 20-30 cents off that basis at a time. And hopefully if this Bill Ackman-led SPAC ever comes back to life at some point, we'll be the beneficiary of that. And we could pull this up really quickly and take a look at the chart if we want to for Psth. Bear with me. These are the parts where the computer's going to get a little bit slower on me. So let's back this up to the 20-day. And yeah, it's been relatively consistent between this 20 and 25, 50 range. So even if it does continue to trade within that range, we'll happily just collect premium over and over and over. As you can see right here, it's got weekly options. That weekly premium that we could collect is really not too bad. I mean, it's not as big as some of these other returns that you might be able to see when you sell options, but at the same time, we'll take what we can get on this one and keep chipping away at that break-even price. But the point being is, until a deal is announced for this SPAC, there's going to be weekly premium in these options. So we're going to continue to sell those over and over and over. Now let's flip back to our weekly tracker to show what we were doing last week. The other position that we had that actually started terribly but ended up looking okay were the LOTZ, the car lots, May 21st, 7.5 strike puts. And just to illustrate what I was saying about that one, let's pop it into the chart really quickly right here, LOTZ. And this one, let's see, what day was Monday? Monday was the 19th. That sounds right. I think Monday was the 19th. So we rolled into last week with LOTZ trading at 735. We sold the 7 strike puts, which means that, we wanted it to finish at or above 7.5. So it was expired worthless and we hit max profit. Right off the bat, it took a pretty big dip on us, going from 735 down to 641 at the low point, just between Monday, Tuesday, and Wednesday. However, at the back end of Wednesday, we finally saw some good action on that as it jumped back up to 740. It pulled back a bit in Thursday, but on Friday, continued that upward movement, and we closed the week at 752, which is what we always like to see, meaning that if LOTZ doesn't move a single cent, or if it drops 2 cents from between now and May 21st, we're going to hit max profit on the trade. And one of my favorite things about the profit tracker is we could show you exactly how much we'd give that, because between this 350 loss here, actually, let me scroll down to the next week to show you what our actual profit would be. Since these are sitting at 85 cents right now, if LOTZ doesn't move a single cent between now and May 21st, these are going to expire worthless, and we'll hit a, wait for it, $29.75 profit on that position between now and May 1st, just if there's no price movement, and that's what we love about these option selling positions. So we're perfectly happy with that one, despite the fact that for a minute there this past week it was looking pretty dicey. ICLN is one of those clean energy ETFs that we like to be involved with. That one we're perfectly fine with continuing to hold and just chipping away at that break-even price that we've got. STON, this one was a pretty pleasant surprise, I would say. We could go flip over to the trade breakout tab that we have on that one, if I could find it. Here we go. Let me zoom in a little closer on this. Okay, so we got in at STON when it was at 270. We talked a little bit about this one last week, and we've talked about it pretty consistently in the Discord for what we've been doing, but unfortunately, it moved against us pretty hard. What we tried to do is put ourselves in a position, as we can see on row 6, which is labeled row 2 right here on the table. We wanted to put ourselves in a position where, hey, look, it could drop 20 cents and we'll still get our shares called away for 2.5 a share. And since we bought the shares at 2.7 and sold a covered call for 60 cents a pop, that means our break-even price was 210, which for the short period of time, we entered this on 3/23 and it initially was going to expire on April 16th. For that short period of time, we thought that was some pretty good value to have a 210 break-even price on a 270 stock. But we'll flip over to the chart here just to illustrate what was going on with that STON. Oops, accidentally put a backslash in there. Right when we enter this, we're going to have to back up a little further even. Let's go to the 180-day chart. Yeah, so we took advantage of the volatility from the spike, and I think we got in right around 270s right here on the chart. So as you can see, the tail end of this drop, we got hit pretty hard, and it got all the way down to, about 170 at one point, which is super, super low when you've got a 210 basis in a stock. It's super low when you get in on something at 270. We love the fact that these option selling strategies gave us a 210 basis. But either way, we were sitting, or at least temporarily, and temporarily being the key word here, because a lot of these losses that we have are temporary for the strategy that we're running. But we were looking at a decent loss when this thing was trading at 170. However, we could zoom in a little bit here to the 10-day chart. And right before April 16th, and April 16th is going to be this call right here, we saw a pretty big move in the stock as it went from $1.70 up to $2.16, which actually, for the time being, took us from a loss to a gain on that position and allowed us to sell more 2.5 strike calls for 16 more cents, which dropped our break-even price from 210 down to 194. So now we're sitting on this stock that's trading at 230, and our break-even price is 194 down here. So if it finishes where it is at 231 on May 21st, which is when these expire, we're going to hit a 1480 profit, which is a 17.6% return on capital in a play that just took a couple of months. So that's really not bad at all, especially considering the fact that this stock dropped 14.44% on us, and we're still able to come out with this incredible return on our capital that we have invested in that one. So yeah, all in all, that one was a super pleasant surprise when it turned around mid-April for us. And we're hoping it just, stays where it is. If it jumps up even further to 250 by the time that it expires, we'll make even more money. We'll be sitting on a 26% return on that one, which would be super, super nice for us. But for the time being, 231, if it just stays flat from here, and that kind of applies to every single position we've got. I mean, if every single position we had stayed flat between now and the end of time, we would be living on an island somewhere, because that's how this works when all this extrinsic value disappears on the options that you sell. But back to what we were doing, looking at our week in review. And again, this was one of the best weeks that we've had on the year and in a while. We could flip over to this 2021 summary tab. Hold on, it's lagging a bit on me here. There we go. Now it's zoomed out, and we could flip over to this 2021 summary tab. And this week 418, the week that we just finished up, $14,139 profit, the second best week of the year so far, because back in the beginning of March, we had one where we came through with 15K. So that is always something we like to see if we're pushing the best week of the year. Hopefully we could keep up this stretch of green that we've got going if we ignore the little blunder that we had with the call spreads on the week of April 11th. But I like the way we're positioned going forward, just going further down the list. NNDM has been an awesome trade for us. We could go to that breakout tab as well. This is similar to the STON trade, not necessarily in risk, but in setup, in the fact that, hey, we got in on this stock when it was trading at 662 right here, and we were able to sell something for 51 cents a premium, which got our break-even price down to 611 and left some really solid upside here, the potential for a 22.58% return in about a month's time, which annualizes to almost 1,000% if NNDM finishes anywhere at 750 or above at the time of expiry, which is going to be May 21st. So we'll happily just sit back and relax on that one and let that play out. But this is kind of the flip side, where we just looked at STON and said, hey, we got in on a stock at a certain price, we sold a call, and it moved against us, and we still made money on that so far. But it's even easier, obviously, when you get in on a stock, you sell a call, and it goes up for you. These are the kind of quick returns that you could pull, and they annualize to such nice numbers. And that's what we're all about here. We're all about having small gains that compound to these big annual numbers instead of chasing these 50, 60, 70, 100% returns in a short period of time. And we've got a question: is most of our capital used selling options, or do we split it with long-term or dividend stocks? So I will say, for the purpose of what we do on this channel and what we're talking about, all the account balance here and the account balance that we track and share is all going to be in option selling strategies, whether that is selling cash secured puts, selling spreads, or selling covered calls on stock that we own. So in a sense, we could potentially use this to open a long-term stock position if we see something that we like. But I will say, like in my retirement account, that's the kind of, I guess, the money that I have on the side. Those are invested more so in long-term stocks. And to be honest, I don't pick individual stocks. I just throw it all in a total stock index because my investment horizon is long enough. And I think that's the best way to have, especially if you're more than 10 or 15 years away from retirement, I think you should have majority of your money in some sort of total stock index, because just about every single correction or major pullback that we've seen in equity markets has been recovered in a relatively short time frame. And we've got Sleepy Condor checking into the Twitch chat, letting us know that we love annualizing the 2-day trades. And hey, we've got to get our clickbait in somehow. We've got to draw the viewers in with something. So that's what we've got right now. But I will say the one we just did was a 1-month return annualized. So I think that's a little bit, I think that might be a little bit more fair. But again, appreciate you jumping into the stream that we've got tonight. He is one of our most successful members that we've got in our Discord server. So moving further down the list here, RMO is another big one that we've been sitting on. We started this one out, and I've updated my tracker a little bit to start showing a break-even tracker, break-even price tracker, to demonstrate, we talk about and preach patience so much on this channel and how we can over time decrease our basis. Well, this is such a great example of us being able to do that, because we jumped into this trade on April 7th when the price was at 1134, as you could see up here, when we jumped into this trade on April 7th. But even when we started rolling this forward, when our April 16th plays expired and we moved into the May plays, as you can see here, between April 7th and April 19th, we took our break-even price from $10.68 down to $8.23, which is a huge reduction and a really great number to be at, since RMO is now trading at $8.52. And again, this is one of those plays where it sucks because it moved against us. From the time that we entered the trade, the stock has dropped 25% in just a few short weeks, which is a pretty big downward move. And that's part of the game when you're trying to chase premiums a little bit like this. And that's something, admittedly, we've been trying to get a little bit better at, finding plays where there's a good mix of both stock value and option premium, instead of just blindly chasing option premium, because results like this are relatively commonplace when you blindly throw money at big time premiums. And we'll talk a little bit more about that as I show you guys what I'm set up with for next week. But back to this play, we've been able to get our break-even price down to 823. This one has also been a little bit of a roller coaster. We could flip over to the chart and type in RMO up here to pull up the chart. And as you can see, here's that 1023 number. I mean, this is, I think, right around when we entered the trade, maybe a few days afterwards. But it went from that 1023 number down to 691 at the low point here last Wednesday. And that's when we were seriously regretting the trade. But again, patience is a virtue with this strategy. and it ran all the way back up to what looks like $8.60 after market Friday. So we're perfectly happy with being at 860. 852 was the official closing price. So that's what we've got in the tracker since we used that Google Finance function to pull it in. But if it stays at 852, we're going to, finish the train of thought here out when we say, hey, if it finishes at $8.52 between now and May 21st, we're going to pull a $14.50 profit, which is fantastic, and really fantastic when you take into consideration the fact that the stock that we played has dropped. So we've got another question from the YouTube channel with Matthew M. This is, so not portfolio margin, but we do use advanced margin, which is super helpful. And even if you could get any sort of margin from your broker, I will caution you to be very careful with that and be 100% sure that you know what you're doing. And one of the basic points that we make in this HT wheel strategy that we run is always enter with less than 100% of the capital that you're comfortable with investing into that play, because then that lets you further lower that break-even price by adding more capital to the trade at lower stock prices if it turns against you. And this is a great example of when we do that. But why we do like to use portfolio margin, and we could jump ahead, we don't have, to clarify, portfolio margin is a very special type of margin reserved for, I think most brokers have the cutoff around $115,000, $125,000 in your account, where you could get some serious leverage. We do not have that. We have what TD Ameritrade calls advanced margin, which lets us get a little bit of leverage and has a margin requirement that's dependent upon what TD Ameritrade assesses the risk level of a certain stock to be at. So, a great example of this, jumping ahead slightly, I deleted the tab out because the trade was over, but I can show you in the summary spreadsheet that we've got right here, the AMD trade that we had open last, if we really go back here, we opened it a while ago. It took a second for it to finally turn into profit, but you'll see you can't see the quantity that we have, but we sold about 5 AMD puts, and it only took just under $10,000 of collateral, which is great because theoretically that's roughly it would cost about $8,000 per cash secured put, so it's roughly a $40,000 position, but it only takes just under $10,000 of buying power for us, which when you divide your profit by that lowered amount of collateral results in better returns objectively. And while this wasn't the greatest return in the world, and again, we could see the stock dropped 6.17% on us, so we're happy to have any return at all. But moving forward, looking, for example, Zillow is one where we're using this as well. Zillow, last week we had a 2-day play where we were able to return $810 on just $7,700 of collateral for a 10.49% return in 2 days, thanks to that additional leverage that the margin granted us. So that is something we're trying to use a little bit more going forward as we try to move into safer, more stable stocks, because those more stable stocks, while they don't have as attractive premiums on a weekly basis, as attractive return on risk percentages, when you take that profit that they give you and divide it by the buying power that is used up as opposed to the actual amount of money that it would require to have that be 100% cash secured, your returns look a lot better than the low amounts that are displayed if you only analyze on a return on risk percent basis. So jumping back and hopefully wrapping up this weekly review right here, we got in on Coinbase we got in and out very, very quickly. That one was, I think, a 1-day play, so for those of you who love to factor in the annualization of our returns, we're not even going to touch that one because I think it came out to a 7 billion % annualized return, which is just so far beyond the point of being useful. And yes, Sleepy Condor dropped in the Twitch chat making a comment that factoring in capital efficiency, having better margin requirements can increase your gains a ton. And it helps you play safer stocks instead of these things like RMO where, you're holding on for dear life because this thing is a roller coaster and you don't know where it's going to end up at the end of the day, and you could leave yourself susceptible to a pretty large drop. Whereas with AMD, stable stock, we know what they do for business, semiconductor manufacturer, huge demand for something like that. It trades in a relatively stable range. I mean, it's been in the mid 70s to high 80s that's not the most stable range in the world, but for the amount of premiums that they offer, that's relatively stable. So that's something where, it's a lot less stressful to sit back with an AMD put than it is for something like an RMO where it's moving all over the place on you. And that's why we have also added in column A here under our tracker the classifications of how we assess our risk on each trade. We've got safer plays outlined in green, more premium chasing plays like we talked about with RMO that are highlighted yellow, and then our hedges highlighted in orange here. But that's something we're trying to be a little more cognizant of as we continue moving forward throughout the year. Because if we go to our year-to-date summary tab, our account balance and returns, this is quite frankly heart attack inducing. Every time I have a big drop like this, I feel terrible about it. And while with our strategy, the idea is it'll be recovered at some point relatively quickly, we definitely want to try to smooth out this gains curve. Maybe just for, if anything, my own sanity moving forward here with you guys. But that's something we're going to be looking to do going forward. Zillow is a great example of that. And this was the front end, or I guess maybe two parts of a front end of what we're trying to do with the 10-day earnings play. Zillow reports not this next week. If we pull the calendar up, they don't report here. Excuse me, they don't report in this week, but I think they report May 5th, so one extra week. And the idea with that 10-day earnings play is that it's been statistically proven in a peer-reviewed research paper, which I can link at some point soon. But in the week leading up to earnings, there's a greater than 50% chance that a stock will run up or finish higher than what it started the week at. So what that means for us in our option selling strategies is that we can sell an at-the-money put expiring the week before earnings, and greater than 50% of the time, that's going to expire for max profit for us. So that's what we've done. We did it for 423 just because I felt there'd be an even greater run up, but we could skip ahead a little bit here and show what I'm holding for next week. But as you can see, we went in a little bit heavier with Zillow for expiry this Friday. What was just out of the money at 131, and we could look at the Zillow chart really quickly to show you how this one has gone for us. But we got in on this one right about here when it was clear to us that our initial Zillow puts were going to expire. Excuse me, we got in right around here at the 134 level when it was clear to us that our initial Zillow puts were on track to expiring worthless. We rolled into that position for next week a little bit early, but it has since run up to 137. And as you can see, we're already showing a pretty decent profit of 464. But as long as it stays above 131 next week, aka doesn't drop about 6% on us, we're going to get another $1,000 of profit. And that is what we love so much about these option selling strategies, how low effort and low stress they are. So we've got a couple questions here. The first one in the Twitch chat that I do want to address, and it is the stream replacing the weekly trade ideas newsletter? And that is a great question. I have been intending to keep the newsletter going, but in spite of all of the things that I've had happen as far as the technical problems I've had with my main laptop dying on me, and I still haven't received it back from the manufacturer yet. This new laptop I have, the computing power is nowhere near as good. I'm actually surprised that it's going well right now, although I'm getting a notification that encoding is overloaded. So maybe not as great as I was hoping. But point being, when I try to actually have all these windows open and throw together the newsletter, it is super, super slow. And you can almost see right now me just trying to make circles with my mouse. The thing is glitching across the screen. So I do hope to recontinue the Trade Ideas newsletter once I get the old computer back and it is not such a technical pain in the ass for me to actually go about compiling that. So that is temporarily on hold, but will be coming back. And then in the meantime, we're going to have these Trade Ideas streams every single week, regardless of whether or not the newsletter runs. But hopefully, for those of you that did read the newsletter, this could at least suffice a little bit to help replace the void that the newsletter has left. We have another question about Candace Industries. I got to be honest, I have no idea what it is, and I hope it's not. Let's see. Oh no, I feel like I've fallen for a prank right here with Candace Industries. You can go ahead and finish that one out in the chat if you'd like to. But I think that may fall in the same category as, let's see, we got another question here. Are you doing any put spreads on your earnings strat or only cash secured puts? That's from J Marts in the Twitch stream. As of right now, I love this 10-day strategy that we've got going with the amount of premium you've got and the ability that it gives you to just lower your break-even price about 3 different times over the course of, the 10 to 14 day period that you're going to be playing that. So as of right now, I'm kind of partial to doing that. However, if you do want to play, earnings is one of the best times of the year for implied volatility, so I don't think credit spreads are a bad idea either way. And I am doing the strategy on things that I think will go up during their earnings. So I guess you could sort of infer the fact that, hey, if I'm running a 10-day play on something like this, you could also, that might be a green light for you to enter with a put credit spread to sell as a bullish position. If you don't have quite enough capital to be running something like a 10-day play, I think a put credit spread on any of the 10-day play tickers that we run is equally useful. Another question in the YouTube chat. Have we read any good books that changed how we trade or the thought process when we trade? A great question. I know a lot of people do turn to a lot of these investing strategy type books. And to be completely honest, this I'm sure is not the answer you're looking for, but I have not read a single book about investing. Everything that I've learned has been between things that I've read online, resources that I've found on the internet, watching YouTube videos, and a lot of it is I've been doing this for coming up on 8 years now, and I think experience is one of the biggest things. One of the biggest hurdles off the bat that you're going to have to get over is that psychological aspect of trading and kind of mentally detaching yourself from the money, which sounds a little bit scary in theory, but at the same time is what I have found has been one of the most helpful things to help me avoid over trading, making any emotional decisions. And as you can see, I'm still not perfect with that, because we could scroll up to a couple weeks ago where I lost a ton of money doubling down on spreads in one day, where I lost $8,000 in one single day because I got a little bit emotional with the spreads. But I've been doing it for as long as I just said, and I'm still making mistakes in that regard. So I think experience is one of the best teachers. Even if you don't have money, paper trading is a great way to learn that we always talk about, but I do think there isn't quite anything that could replace the actual psychological aspect of you having actual money that matters to you in play in the market. And I think I've had a few big losses in my, I guess what I could call short trading career over the past 8 years. And those, while I could say, oh, I've traded, I have all this experience, blah, 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 that's what's helped me. It quite honestly is having a few big losses that has fully made me, mentally detached from the money that I have in the market, and makes me focus more so on the numbers rather than, oh man, I can't afford to lose this. I can't afford to do this. Oh, this is going down. I need to panic and close, blah, 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 blah. So, it is one of those things where when we set these trades up, we always have defined gains and defined losses. So never make your potential max loss something that's more than you're comfortable taking. But I think if you follow that general rule, the psychological aspect of it will be a lot easier. I think Reddit is also a really good resource, as weird as that sounds to say. Sometimes there's terrible advice on there, but if you could skim through the terrible advice, there are a lot of genuinely helpful and intelligent people on there who share what they know about the market and their experiences. And I think having a trading group like we have, where we throw trade ideas around with each other, we've all made several different mistakes that we hopefully can share the lessons from with each other, so that while the mistake of buying options might have cost me $20,000, hopefully I can impart what I've learned from that lesson onto you guys, so you don't have to make a costly mistake learning that same lesson. So I do think the community aspect of it is also super, super helpful, because no one knows how to trade and invest when they come out of the womb. Everyone started at the exact same point where they didn't know anything about the market. And being in that group and having that group setting where you could feel free to ask questions, where there's no such thing as a stupid question, because I guarantee you any question you might have about the market, someone else in that group either currently has or had at one point. All right, looking back through the chat. Loving the feedback I'm getting live tonight, guys. I always love it when the chat's a little bit more active. It doesn't look like we have any more questions, so we'll keep pushing through it. I think this pretty much takes us about to the end. This AMD position that we closed up was one that we had going for a while, but we talked about that on the HT Wheel Performance tab, where that one closed out for a modest profit. The SPX spreads, where I told you I admittedly was a little bit emotional up here, I kept those rolling. But I will say I objectively took a step back to evaluate, what was so bad about these. It was the fact that I gave myself 2 days, essentially, or 1 day to guess the price movement of the market, which essentially is gambling. So what I did this following week was I gave myself 4 and 6 days to guess the price of the market, which is, I mean, maybe still a little bit gambling, but definitely a much more manageable approach to taking that directional hedge. And then we have the Clover Health 7.5 strike puts that we've sold, and we sold that strike just because if they expire worthless, we will have finally dug ourselves out of the hole that we put ourselves in. We could go over to that trade breakout tab right now, where we started this trade at 12.65. It's dropped 30% on us, and if these expire worthless, we will squeak out a modest $10 in profit. But at this point, I am just thrilled to get out with anything remotely near break-even price after how bad the price action on this one has been for us. But that should close the loop on the discussion about our performance last week. That's our recap. We made $6,000 from our HT wheel strategy and a really solid $8,130 from the credit spreads that we sold to hedge our positions, which if our hedge was making this much money, we admittedly were probably a little too heavy into it. But we've talked about things like RSI and how the market has been severely overbought in the recent trading periods, so we were, okay with having a decently heavy position. J-Mart's saying he might think about opening up a SPY call spread at the end of earnings, which is a bearish hedge on the market. And yeah, I think we are in a position where, earnings dictate the market movement so much during earnings season. But I just, I don't really know what to expect because I feel like so many of these names out in the market have already had these big recovery moves to where you need pretty damn impressive earnings results just to justify what they currently have. So, anything short of that could cause a decent decline. So I'm hesitant heading into earnings, which is why I still have a SPX call spread. And I'm going to keep opening these week after week until we see any sort of decent pullback in the market. And that's the great part about these call spreads is the fact that, hey, I've got this set up at, 42.10. We pull SPX up here. Actually, I don't want to do that because I might, the size of that data request might actually crash my computer. But we've got this at 42.10. I think SPX closed around 441.80 on Friday. And futures, let me check them right now. They're about flat. So the great thing about this is that even though, this is a hedge to play the market down, the market could go up about 1% this week, which would be objectively a pretty decent move upwards, and we could still hit max profit on this. So we're going to keep rolling these forward, and if the market stays flat or goes down next week, we're going to cash in, $1,300 of profit on that, and that's, I think, a much more effective size and less heart attack inducing size than the potential $8,000 of profit that we had. And these expire, one note I want to have is that these expire on Wednesday, April 28th. So we really only have 3 days for the S&P 500 to move up 1%, which is, I think, is a pretty decent value proposition. And our plan from there is maybe to roll those into Fridays. But as I just said, I don't like the idea of having 1 or 2 days to expiration on a spread. So, that might be something I need to back up and think about. I don't know what I want to do from there, but all I know is that I'm happy with what I got here right now, and we'll cross that bridge once we get to it. So with that said, this was what we are currently holding for the next week. We've got these, again, evaluated safe plays, premium chasing plays. One that we've got that we added was on ticker OPEN. We made a little video on that on TikTok for those of you who follow us on other social media accounts. But for those of you who don't have a TikTok, I don't blame you. But we are trying to cover all our bases here on the social media game. But this is where we first talked about this one. We discussed it a little bit in our Discord server. But I do want to talk about this a little further because while we already do have a decent, 10 to 15% of max profit, I do think the entry on this is still pretty solid. We could pull the chart up really quickly. And we've got a couple more questions that have popped up in the chat that I'll circle back around to once we finish this discussion. But this was one I think we timed pretty dang nicely. We didn't get in when it was down at, 16.4, but I could tell you actually when I go to our trade breakout tab, the exact price that we got in on this one at. And we got in 18.6 is when we entered the trade. So right around here, obviously, this was a much better entry than right here. But if you zoom out to see the last, I think, 20 trading days, that'll put in perspective what kind of an entry 18.6 is. it has really dropped off a ton. I like this company. It's a real estate technology company, and I think that's one of the bigger industries that probably is going to move to digital next is real estate. You're seeing Zillow start to take over with all these listings and automatic, hey, we'll buy your home, we'll list it, we'll handle all this for you. But I do think that is one of the industries where we are going to see a shift to digital, and this is one of the companies that is partaking in that shift to digital. So if we zoom further out, I mean, this is a decent entry if we look at it in the span of the last 2 months, because this thing peaked at almost $40 a share. So if we got in, we sold 17.5 strike puts. We said, okay, we sold these for $1.29, which would put us at a break-even price of $16.21. Taking everything that we know about this stock into account, $16.21 shows up right here, and that is a price I'm very, very comfortable holding this stock at in the long term. So let me take a peek back into the chat, because I think we had some good... Let's see. Some good questions. Sleepy Condor asking, for the purpose of diversification, have we ever considered trading futures spreads? We can add crude oil, corn, and gold, for example. And I do like to say I think I know a good bit about the market, but I'll be the first to tell you when I don't know anything and can look into something further, because I don't want to talk out of my ass about something I have zero idea about. But I'm just not terribly familiar with futures commodity trading. I'm familiar, with some of the tickers, how they move, and some more macro trends in the industry. But as far as the actual mechanics of trading those, I'm a little bit in the dark right now. So that is an interesting idea, because that is something we could look into. And being one of those situations where, hey, I've had so many trades where, I might have these SPX call spreads where futures overnight are looking really good and would be opening in a position where I'm profitable, but I can't do anything until the market opens that morning. So I think trading futures contracts and spreads would be a decent way to potentially have a little bit more control over the trades that we enter. And like Sleepy Condor also mentioned in the chat, they do have attractive capital requirements. So that allows you to get a little bit more leverage on your money. But as we always know, with that leverage comes a little additional risk. So, I mean, in conclusion, I don't have a strong opinion either way. I think it is something that is an interesting idea that we should look a little bit more into, potentially as a group at some point. But that is, a great point to bring up, and we'll try to hopefully maybe have a little bit deeper of a discussion about that next week on our next stream after we are a little more educated on it. Another question from the YouTube chat from Quantic. What was one thing you would change when you were beginning option trading? What is the one thing you wish you knew then that I knew now? So I will say the very first time I traded options, I was an option buyer, and that is the experience I think of about 99% of the people out there. And you'll find out very quickly with option buying, while it can be fun to chase these, 40, 50, 60% returns, and it's super fun when you've got a big position that doubles overnight, in the long run, you're not going to make money. You might have a quick hit here and there, but I mean, it's the same concept of you being able to go to a casino. You might get hot at a roulette table, but in the long run, the odds are going to favor the casino, and those casinos exist for a reason, and it is because they make a ton of money by being on the favorable side of the odds. So when you switch over to the option selling side, that is when you put yourself on the favorable side. You essentially become the house. You're selling insurance to other people. So that is that's the side that we want to be on. I wish someone had told me about option selling when I first started investing, period. Because even beyond being a different way to trade options, it's also essentially a glorified way to obtain a long stock position. Because if we were assigned on these, we'd be assigned 1,000 shares with an adjusted basis of 621, which is much, much better than purchasing shares if we wanted just to invest in the stock. It's much better than purchasing shares at 1860. So it's advantageous from that perspective as well. And I think, after all the different trading strategies that I've tried and seen, I mean, I started with just buying boring stocks. I got into penny stock trading. I got into option buying. I did crypto trading. At the end of the day, option selling is the far most high probability and consistent trading strategy that we have, and that has been awesome for us, and that is what we are going to keep doing going forward. And we, last year conditions were such where you might not be able to expect the level of success that we had last year when we finished plus 168%. You can see this year we're up a good 39.81% as we head into May. So we're hoping we can just continue to build on that. And until we, I guess, run into a lack of success, I've got no reason to believe that this won't keep working, because essentially, like we mentioned a second ago, it's just glorified stock ownership. It's just another way to be long on the market and hold positions. So I'm going to keep moving through here. Hopefully that answered your question. If you got any follow-up to anything that I just mentioned in there, feel free to throw it in the chat, and I'll happily address it. We've got J Mart saying he's never traded futures. Would be interesting to learn, though. I'm in the same boat as you. I was approved for futures trading because I think in the back of my head I wanted to have that in my back pocket just in case I needed to do something overnight that was going to materially affect the positions I was holding and couldn't manage during those after hours trading sessions, but I've never actually used that privilege. Let's see. Going through the chat a little bit more here. Yeah, we've got some relatable stories. I think that might have hit home for Quantic about making a bunch of money off options and thinking, wow, this is awesome. I'm going to be a millionaire by the time, millionaire a year from now, and then slowly understanding the reality of that type of trading. And it is so damaging too, because on social media, you'll see so many people who, well, I'll be the first to tell you, you'll have great weeks. Your great weeks will be way better than our great weeks because you'll make a ton of money and have a huge percent return. And those are the things that you see getting shared on social media. So to someone who might not know any better or might be new to trading and is looking into trying to find different ways and strategies and ideas on how to trade, that's definitely eye-catching. I mean, if I didn't know any better and I saw someone sharing screenshots of them making, 200% a week, I'd be like, okay, I want to sign up for this. But the reality is that, while their great weeks might be much better than our great weeks, their bad weeks are going to blow up their account if they continue to take on that kind of risk on a week-to-week, month-to-month, and year-to-year basis. So, circling back around, that is why I think the option selling strategies we have are awesome. That is what I wish I knew about when I first started trading. And I think it's so damaging when people who use these option buying strategies, which will give you eye-popping returns for a moment, share all those on social media, and that's what people see, and they get suckered into it. In the long run, people who are on the other side of those trades are going to come out on top. We essentially are equivalent to being the house of a casino. We put ourselves in high probability trades where we make small returns week after week, which are going to compound to hopefully big amounts. And if there's a pullback in the market, instead of having our accounts get blown up, we'll just have, brief pullbacks. We'll live to trade another day. We'll keep lowering our break-even prices and keep moving forward from there. The options we sell expire, but the stock that we have and these positions we have, we can roll them forward forever. You don't get that luxury with option buying. And that'll be the end of my my miniature rant, and we could go back into talking a little bit more about what we're looking at for the upcoming week. UXIN, let's talk about that one really quickly, because I think that's one that's always a good time to discuss when we're looking at potential trade ideas, because we've gone to the well many different times on UXIN. So let me throw that one up on the chart so you can see what I'm looking at. And there are several large green candles. I think we actually started playing it, I think beginning of February maybe is when I first got into UXIN. And my grand plan was I was going to sell a 2-strike call, and I was going to get them called away for 2 one day. But as you can see here, when it was trading in this 150 range, it fell back to about $1. I think $1.20 is when I first cut ties with it and said, okay, I'm happy to get out with a small profit. But then it dropped a little further down to $1.05, and I said, okay, I was happy to buy in at $1.50, so I'm absolutely over the moon to have the opportunity to sell a 1-strike put for a decent premium. And the great part about these stocks that trade at such low dollar values, and again, a dollar value isn't necessarily a reflection of the valuation of the stock, it's just the share price. But when we calculate our risk, calculate our returns rather, the great part about these lower priced stocks is that it doesn't take a lot of premium to get a pretty dang big return. So for example, let me pull up the calculator here so you guys can see the returns that I'm talking about here. Pull this onto my main screen. But for example, let's say you sell a 1-strike put, and that's what we did back when it was around here, and we sold it for, I think, let's say we sold 10 cents of premium. So you're getting 10 cents of premium, but the amount of collateral isn't that large either. So it's a 1-strike put. You're getting 10 cents of premium, so your max loss on that is really 0.9. So 0.1 divided by 0.9 means that if you sell a 1-strike put on this for 10 cents, you're getting an 11.11% return on your amount at risk, which is a phenomenal return. And what's even crazier, that example that we talked about is what was happening when UXIN was down near $1. What is even crazier, and we could plot this right here to show you the increase in implied volatility, but when the stock spikes like this, and as we can see over the past month, it's happened a couple times, and we took advantage both times. But when it spikes like this, it creates this volatility which drives option premium. So the price has dropped a little bit since we entered, but we were able to sell a bunch of these for 5 cents a piece. And you might say, okay, I mean, that's relatively worthless. What is the point of selling a bunch of those for 5 cents a piece? I don't really understand that. But let me drag the calculator over once more to show you that, hey, if we sell something for 5 cents a premium, that means our max risk is 95. And if we divide that 5 cents of premium by the 95 cents we have at risk, that sits us with a 5.2% return that we're going to receive in a month, just as long as UXIN finishes above $1. And we opened this trade when UXIN was above $2. So we essentially put ourselves in a position where as long as UXIN doesn't drop 50%, and in the past, 3 months or so, it hasn't really traded below $1, and it's about as high as it's been in that range. But as long as it trades above $1 on May 21st, what we sold is going to expire worthless, and we're going to get this 5.26% return for what, at least in my opinion, is one of the lowest risk returns you could get in the market on a month-to-month basis. And that's a great number, 5% in 1 month. And as you can see right here, we sold 100 of them. Our max profit would be $500 on that. And the way I view that, that's almost a free $500. It's not taking a ton of buying power up. And even if it took a lot of our buying power up, I'd be perfectly happy to sit back and just wait for a relatively low stress 5% return. But again, these were at, I think, 2.5 cents, so we'll round it up to 3. But as of right now, we've already made a couple $100 off it, and we'll collect that remaining $300 just as long as it stays above $1. And we've got Sleepy Condor in the Twitch chat letting us know his cost basis is 92 cents. So we have been beaten on that one with our measly 95-cent cost basis potentially on the puts that we sold. But he was one. Correct me if I'm wrong. I think you were holding those shares uncovered for a little bit of time. So when we finally got this spike right here that we were looking at, you got a really, really nice amount of premium on those and have a phenomenal cost basis. And the 92-cent cost basis at this price means you're looking at over a 100% gain on that investment. So that is an awesome trade. Let's keep looking further down the list. OCGN was another interesting one that we wanted to jump in on. That's one where it was hitting headlines because this stock is flying out of nowhere. Let me actually pull this chart up so you guys can look at it as I go through and talk about it. Yeah, OCGN, as you can see, this thing, first off, scares the hell out of me because it was trading at about 20 cents a share back on December 21st. Now, I will say, setups like these we try to stay the hell away from because the biggest risk with this strategy is that the stock moves down faster than we could drop our break-even price. And we get to the point where it's so far below our break-even price that we can't get any good premium, and we essentially just have to exit the position with the loss. And famously, as we like to talk about so much on this channel, this happened to us right here where we entered highly on right at this level and got absolutely crushed on the way down. And I'll be the first to tell you this was the single worst trade we made. At the time we made it last year, we were kind of in the mindset of, hey, when we started off trading with this account, it was kind of play money for us. It has since grown to an amount that is not play money, but I still had that mentality of where, it was money that I had on the side, so I was throwing all of it all into every single trade that I made, and it worked until it didn't. But point being is we were all in on Hyliion at this level. It dropped all the way down to here. It dropped 75%. And we were still able to recover our account and get back to new all-time highs in our account less than a year later. So that's the point. A lot of people always ask, hey, when you run the strategy, what if something like the COVID crash happens again? And I could confidently tell you that I had 100% of my account in this stock that dropped 75%, which is far more than the market could ever drop. And we were able to recover back to break even relatively quickly. So that is my little anecdotal example of when people say, hey, what happens if the market drops? What happens to this strategy if there's a crash in the market? I have a concrete example of something I could point to where we had one of the biggest crashes imaginable happen to something our entire account was tied up in, and we were still able to come out okay. But back to OCGN, which is what we were just talking about. This thing went up to 1877. We'll always get a lot of questions in our Discord server, on our videos, when things like this happen and there's a stock that jumps up this much, because naturally, you've got a stock that went from 20 cents and it's pushing 20 bucks a pop. That's going to be making the news. You're going to be seeing that one on social media because there'll be, a handful of people who were in on it super early, who had big positions. They're going to be sharing their gains, and people are going to say, okay, I want to get on this. I want to get in on that. And they're going to try to invest in it, yada, yada, yada. I feel like I'm rambling a bit here, so let me get back to my point, which is these are going to come to the forefront of attention when they have a chart that looks like this, just because objectively this type of action in the stock market is exciting. People like to see it. People like to talk about it. And the other thing that it creates is a lot of option premium. So in the context of our strategy, people will look at return on risk and say, hey, we've got this 10 strike put here expiring May 21st that's offering, 36.52% of returns in a month, which is fantastic for something that's basically at the money. People will always pop into the chat and say, HT, is this something that I should be selling? But it's always important to remember the fact that if a chart looks like this, and we'd be getting questions when it was up here or up here at 14, if something runs up this quickly, it's probably going to run back down just as quickly. It's only a matter of time. Charts that look like this are in no way, shape, or form based on some sort of fundamental, nice, organic upwards move. Now, I will say this is a pharmaceutical company, so there was a little bit of news that spiked it and probably justifies a price that's a lot higher than 25 cents a share. But is that price $10 a share? That is where I'm a little bit, iffy about that. If it's worth a 50x multiple of what it was previously before this initial news dropped. But with that in mind, we know that this type of jump, this type of implied volatility increase creates a lot of premiums. How can we take advantage of that? And for me, I loved the idea of selling 5-strike puts. We were able to get 38 cents of premium on those, which means our break-even price is going to be about $4.60 a share, which on the chart is right here and is a price that it hasn't traded at since last February. And that was, during the news outbreak when all of the good PR and all the good publicity was coming out for Ocgn. But point being, as long as it stays above 460, we're going to hit max profit on these. And max profit on these is an 8.58% return in just 1 month. We talk about annualizing returns. 8.58% return, I don't know what it is off the top of my head, but it is a pretty dang solid return. So let me actually open up our profit tracker for this one, because I can actually tell you what kind of return that is that we'd be looking at. We can go over to the Ocgn tab that we've got working right here. And you'll see, break-even price is 462. We started this trade on 423. It ends on 521. We've put ourselves in a position where we'll make an 8.225% return on capital, which over the course of a month, if annualized over an entire year, is a 180% annualized return. So with a trade like this, we put ourselves in a position where, hey, it is probably very, very high probability that it finishes above 460 by May 21st, because it just hasn't traded below then in, a decent period of time. So you'd imagine it would take a little bit of time, especially from the current price of $11.06, to get back down to this 460 level. So we love the fact that we're able to put ourselves in that high probability trade on something where, it's super high probability and the return is 8.2%, but it annualizes as something that's an awesome number. And if we could just keep doing this week after week, month over month, and continue that into yearly performance, our returns are going to be looking really, really solid. So that's what was attractive to me about that play. And admittedly, this isn't a great fundamental stock that I'd be thrilled with holding long term. And I think there's some great bold thesis long term. It admittedly is premium chasing, but I've got it in there labeled as such. But it's premium chasing in such a way that we've got this enormous cushion. I like the return profile that it sets me up with. So that's why I'm happy with it for the short term at least. And that, I think, kind of rounds out all the important ones that I wanted to talk about as far as heading into this week. We got some big earnings coming up. But I think the things that we have opened and actually, put our money where our mouth is, quote unquote, are some of the best options that, no pun intended, but some of the best options that we had out there in the market. Now, there is one thing that I did want to address, and I think would be a great thing to bring up and do live on the stream with you guys, is the fact that, hey, when I actually take a step back and classify what my plays look like, we've got a lot of yellow right here. We got a lot of premium chasing. I want to move into these safer plays because, hey, I'm hedging my profile with the S&P 500, right? I'm hedging my portfolio with something that'll make money if the S&P 500 goes down. But the question that's important to take a step back and ask ourselves is, hey, how many of these stocks that I'm playing are actually in the S&P 500 and correlated to that? And the answer is not very many. So we're trying to move more into these green names that have a little bit more of a beta, a little bit more of a correlation with the S&P 500 so that our hedge is actually effective. So how are we going to do that? We normally like to use that scan tab in Thinkorswim to go take a look at the options with the best premium in the market. But what we could actually do is take a look at all of the options in the S&P 500 and then look at the best returns in there individually and try to evaluate something from there so that instead of pulling our scan pool from this enormous pool of every single stock that's out there on the market today, we could pull it from a safer, more reliable pool of S&P 500 stocks. And shout out to Sierra joining us in the Twitch chat. Thank you for popping in. We always love it when you guys are joining us live on these Sunday streams. So getting into what we kind of set up there is the fact that we're going to go into the option hacker, our scan tab on Thinkorswim, and we are going to scan not for all symbols, but if we go to public, there it is, the S&P 500. So if we select this, we're able to search for every option on every stock in the S&P 500. So we're going to scan for that. It's going to pull you a ton of results. We've got 364,000 results, in fact. And I want to sort these, let's see, by return on risk, because as we remember from what we'd like to talk about all the time, return on risk is probably the single best way to evaluate the amount of premium of an option relative to the price itself. So we're going to sort these by return on risk, and we actually need to add return on risk into here. So bear with me as I scroll through these. There we go. We're going to add return on risk. We're going to sort, and it looks like we might be, let's see. I think we're going to want these to be descending. So yeah, bear with me as I learn my number sorting as well live on the stream. Going really smoothly right here. Okay, there we go. We've got some options that have some incredible return on risk. And you'll remember from our scanning video that we made, a lot of these high return on risk numbers that you see are going to exist because of weird option spreads, of no volume. And as you can see, there's no volume on a lot of these. So we want to add a couple filters right here. Our first that we're going to want to add is going to be, scroll down here to the V's, volume. And let's say we want at least 20 of these contracts traded so we can be sure there's at least some sort of trading activity with those options. And now we've got a little bit more action. We've got some seriously high premiums. But the other thing that we want to do is make sure that these things are out of the money. So we can sort by percent out of the money. And we'll do minimum 0.0. I want to be 0.01 just to make sure they're out of the money, period. So let's scan for those. Now we've got all out of the money stocks in the S&P 500 index. Excuse me, all out of the money options from the S&P 500 index sorted by return on risk. And now the other thing that is probably going to be an issue here is we see a lot of later expiries, right? We've got some June expiries. That's why we've got some big numbers here. So what we want to search for is weekly option expiries. So we're going to add another filter, option filter. It's going to be days to expiration, and we're going to make that 7 days, 7 days maximum to pull up all options that are expiring within the week, not 7,782, but 7. So scan for that. And there we go. We've got Twitter. We've got Dish. We've got GLW. I have no idea what GLW is, but we've got it in there, and it's in the S&P 500. We got WDC. We've got AMD. And then the next thing that you're going to want to kind of parse from this information is the fact that, hey, these are some great return on risk numbers for stocks that are presumably pretty solid because they're in the S&P 500. However, we know it's earnings season, so how much of this is because of the fact that there are earnings? And this is where you might want to bear with me a little bit, because I think there's a way to scan as well for earnings. That's all fundamental info. Let's X that one out. We're learning together here. If anyone knows how to do it, feel free to drop that one in there. Study, maybe? Don't think it's study. Maybe pattern. Not pattern at all. Not even close on that one. So 0 for 3 right there. Another swing and a miss. We're going to give this one more try before I completely give up, so you guys don't just sit here and watch me mess around on my computer all night. Let's see if there's anything for earnings. It doesn't look like it. Doesn't look like it. But we know another quick way to do that is by going over to our watch list here. We've got Twitter as the very first result right here. So what we could do is type in TWTR. It'll pop up. There's a little blue circle you'll hit, and you'll find out that they're reporting earnings on April 29th. So we know that, earnings are this week. That's why the premiums are inflated. So maybe stay away from that one if you're looking for something that's not an earnings play, but a high premium play. But, you can go down the list, do the same thing, and there definitely is a way to sort by like what companies do and don't have earnings. So I will figure that out and let you guys know, but I'm not going to mess around with it live here on the stream. But circling around and finishing up this discussion about shifting our portfolio to have something with a lot more of these green indicators showing that we've got a relatively safe play comparatively, we're going to maybe start to pull from a little bit different of a pool when we run our scans. Things like the S&P 500, even if you wanted to jump into the Russell index, which is a little bit sketchier, but point being, there's a lot of different areas that you could search through. We've got upcoming earnings here. There's a way you could actually, I guess, scan in the pool of stocks with upcoming earnings. But if you actually play around with some of these lists that you could search through, there's some pretty interesting stuff, right? We've got some of the biggest gainers on the day. We got sizzling stocks. We got volatility increases, which is exactly what we want when we're looking for option selling. And while that's for the scanner, you could actually do this over here in your quick watch list. These same categories are up, right? So if we wanted to see the biggest volatility increases in the market, we'd click on that and you'd see that they're all right here. And you could go individually, take a look at and analyze a lot of those stocks. If you wanted to see something like, let's see, top 10, net gain on the NASDAQ. There you go right there. We've got some huge gainers. And that is kind of how you use those custom public stock lists. And they're super, super helpful because they're predetermined, pre-compiled, and you could just go through and play around with these forever until you find something that you like as you scan the, scan the market, look for trade ideas, because we know from the strategies that we run, selling options on something is a pretty easy way to go ahead and play it. But a lot of the time, the hardest part is actually, picking a solid stock. And admittedly, that is something, and those of you who follow us know this very well, but we struggle with that pretty big time. As you can see by our stock return, we actually have it summarized up here just so I could highlight to all of you how terrible our stock picking has been. But our average stock return is minus 1.4%, which is just awful and is making things so much harder on ourselves than we need them to be. But our average return is 7.32%. So that's great. That's the silver lining, that really just further demonstrating the value behind this strategy and showing why what we're doing works. But as you see, we'll try to give a little more context when we alert our plays in our HD Trades channel on our Discord server. Talk about, maybe what pool of stocks we're picking things from, if we think things are, if we're shamelessly chasing premiums, or if, hey, this is a little bit steadier of a stock, but decent weekly premium opportunity, low margin requirement, meaning that our return on our capital or return on our collateral, the buying power that they take from us, is effectively a lot better. So that's something we'll try to work on. We'll try to get a little bit more green out to the side here, and we'll try to get as much green as we can on this side right here. But that should sum up everything that we've got going for the next week. I hope I was able to answer most of you guys' questions. We're just over the hour mark here, so I think we're going to try to wrap it up for this one. And on my stream preview over to the left here, the screen is entirely frozen, so I don't even know if the stream is even working at this point. So that's something that, the chat's gotten a little quiet. I'm not hearing too much. My stream preview's frozen, so I don't even know if this is working. However, we are going to wrap this up. So hopefully, at least if you're watching this, the replay on YouTube, it should upload properly and not be frozen, even if the live stream is frozen. But we will, there we go. We finally got some. Okay, perfect. We have a comment in the Twitch channel from one Tom K. Shout out to Tom K, who I guess got fed up with watching me stumble through this. We're going to add the filter. It is under study. It is under corporate actions and earnings. Awesome. Anytime, and we can say does not have earnings in the next 10 days. That is perfect. Thank you so much for helping me out with that one in the Twitch chat. Awesome. So now we have a list of stocks in the S&P 500 which don't have upcoming earnings this week, but have decent return on risk for puts that are out of the money. And this might be a good place to start if you're looking on starting up a play on something MU. That could be a good one, 1.32% a week. And as we mention all the time on here, 1.32% in a week isn't going to blow anyone's socks off. But if you keep getting that every week, you're going to have some pretty impressive gains to look back on at the end of the year. So glad we finally got that loose end tied up with the scan. That should cover everything that we've got that we're sitting on heading into next week. We recapped last week. We answered some questions, but hopefully we were able to, give some more context to these plays that we talk about so much in our chat, show the mindset that we have when we enter these plays, the mindset that we have as we hold on to these, and our, plan moving forward as we approach monthly expiry for a lot of these plays that we have open. Once again, thank you to everyone who tuned in tonight. We are going to wrap it up right here. If you have any questions, feel free to throw them in the Discord server, and I'm always happy and monitoring that channel, so I will be happy to answer any questions that you guys throw into there. But until next time, this has been the Hourglass Trader, where as time passes, we make money. Thank you guys.